The batch factory that democratized Silicon Valley. The story of 500 global, former 500 startups venture capital. It's 2010, and Silicon Valley is still recovering from the financial crisis. The big venture capital firms on Sand Hill Road are playing it safe, writing larger checks to fewer companies, focusing on proven entrepreneurs with pedigree. The barrier to entry has never been higher. If you're a first-time founder without a Stanford degree or a previous exit, good luck getting a meeting. Dave McClure sees something different. He's sitting in a cramped office in Mountain View, staring at a spreadsheet that would make traditional VCs laugh. 500 companies. 5 investments per week. $25,000 to $50,000 each. No time for lengthy due diligence. No time for elaborate investment memos. Just rapid-fire decisions based on gut, metrics, and a 15-minute pitch. Everyone thinks he's crazy. 500 companies? That's not venture capital, that's chaos. How do you manage 500 portfolio companies? How do you add value? How do you even keep track? But McClure isn't trying to copy Sequoia or Kleiner Perkins. He's building something entirely different. A factory for startups. A batch processing system inspired by Paul Graham's Y Combinator but taken to an extreme. Not 12 companies per batch like YC. Not 20 or 30. 100 companies. Twice a year. 500 over 5 years. This isn't about finding the next Google. It's about hitting singles and doubles, with the occasional home run. It's about the power law, but approaching it from volume rather than selection. If 1 in 20 seed investments returns the fund, then invest in 100 companies and you'll find 5 winners. Simple math. Brutal execution. The secret isn't genius founder selection. It's a system that processes deal flow like a factory assembly line while maintaining just enough quality control to beat random chance. It's recognizing that at the seed stage, nobody really knows which companies will win, so the winning strategy is spray and pray with discipline. But there's something else McClure understands that Sand Hill Road doesn't. The world is changing. The cost of starting a company has collapsed. Amazon Web Services means you don't need to buy servers. Smartphones mean global distribution is instant. The internet means you can build a company from anywhere and reach customers everywhere. The old VC model was built for a world where starting a tech company required millions in capital just to get to market. That world is dead. In this new world, the constraint isn't capital, it's talent and distribution. McClure's insight is that there are thousands of talented entrepreneurs outside the traditional Silicon Valley networks who just need a small check and some basic training to have a shot. This moment reveals everything about what made 500 startups different. While others were trying to pick winners, McClure was building a system to create them. While others were raising bigger funds to write bigger checks, he was raising smaller funds to write more checks. While others were focusing on pedigree, he was focusing on metrics. While others were building exclusive clubs, he was building a global platform. The story of 500 startups is not the story of a brilliant investor who picked the next Facebook. It's the story of a system that challenged every assumption about how venture capital should work. It's about democratization and globalization. It's about the tension between quality and quantity. It's about what happens when you take Silicon Valley's model and try to scale it globally without losing what makes it work. It's also a story about hubris and failure, about growing too fast and breaking what made you special, about the difference between a good idea and good execution. Because 500 startups didn't just challenge the venture capital establishment. It also revealed the limits of disruption itself. To understand how Dave McClure built 500 startups, you need to understand the world he entered and why his approach was possible at exactly that moment in time. 2010. The global economy is emerging from the worst financial crisis since the Great Depression. Lehman Brothers collapsed 18 months ago. The stock market lost half its value. Unemployment hit 10%. Banks stopped lending. Venture capital dried up. But something interesting is happening in technology. While the rest of the economy is struggling, tech is bouncing back fast. Really fast. The iPhone launched 3 years ago and already has 85 million users. Facebook has 500 million users. Twitter is exploding. Mobile apps are creating billion-dollar companies in months, not years. The economics of starting a tech company have fundamentally changed. In 2000, launching a web startup required $2 million in capital just to build the product. You needed to buy servers. You needed to hire a dozen engineers. You needed 18 months to ship version 1. By 2010, you can launch a product for $20,000. Amazon Web Services means you pay only for the servers you use. Open source software is free. Cloud infrastructure is cheap. You can build an iPhone app with 2 engineers in 3 months. This changes everything. The bottleneck is no longer capital. It's talent, execution, and distribution. The barrier to entry has collapsed. Anyone with technical skills and an idea can build a product. The question is whether anyone will use it. Traditional venture capital isn't built for this world. The big firms like Sequoia and Benchmark invest $5 to $10 million per company. They write 20 checks per fund. They spend months on due diligence. They take board seats. They're hands-on. This model makes sense when companies need millions to get started and when there are only a few dozen credible startups per year. But in 2010, there are thousands of new startups launching every year. Most will fail. But a few will become huge. The problem is nobody knows which ones. At the seed stage, it's basically impossible to predict winners. The best predictor of success is rapid iteration and customer traction, not the pedigree of the founder or the quality of the initial idea. A new model is emerging. Paul Graham started Y Combinator in 2005 with a radical idea. Instead of investing millions in a few companies, invest small amounts in many companies. Give them $20,000, 3 months of intense training, and access to a network. Then see what happens. The best companies will raise more money from traditional VCs. The rest will die or become small businesses. YC proved the model works. By 2010, YC companies are worth billions. Dropbox, Airbnb, Reddit, Stripe are all in YC's portfolio. The program is wildly oversubscribed. Thousands of applicants for 12 spots per batch. But YC is still small and exclusive. Paul Graham is picking 12 companies twice a year. 24 companies per year. He's looking for technical brilliance and huge markets. He's still acting like a traditional VC in many ways, just earlier and cheaper. Dave McClure sees an opportunity. What if you took the accelerator model and scaled it 10x? What if instead of picking 24 companies per year, you picked 100? What if instead of focusing only on Silicon Valley, you went global? What if you built a factory for startups? The venture capital industry barely exists in its modern form before 1970. A few wealthy families and corporations make early-stage investments, but there's no systematic approach. Venture capital as we know it was essentially created by a handful of firms in the 1970s and 80s in Silicon Valley. The model they built was based on a few assumptions. 1. Starting a tech company requires millions in capital. 2. There are only a few dozen investable opportunities per year. 3. You need deep involvement to add value. 4. You invest in people and teams with pedigree and track records. 5. You focus on huge markets and aim for billion-dollar outcomes. This model worked brilliantly for 3 decades. Sequoia backed Apple, Oracle, Google, YouTube. Kleiner Perkins backed Genentech, Amazon, Google. Benchmark backed eBay, OpenTable, Uber. These firms generated extraordinary returns and created most of the value in Silicon Valley. But by 2010, the assumptions underlying this model are breaking down. The cost of starting a company has dropped 95%. The number of startups has increased 10x. The best entrepreneurs are coming from everywhere, not just Stanford and MIT. The markets are global, not just American. traditional VCs are struggling to adapt. They're still writing $5 to $10 million checks. They're still focused on pedigree. They're still doing months of due diligence. They're missing thousands of opportunities because their model doesn't work at the seed stage. A few investors recognize the shift. Ron Conway starts making small angel investments in hundreds of companies. He bets on volume and network effects. If he's in 200 deals, he'll be the first call when those founders need help or introductions. He becomes the most connected investor in Silicon Valley, not through selection but through ubiquity. Y Combinator systematizes the seed stage with the accelerator model. Instead of trying to pick winners, create an environment that reveals winners. Give founders resources, training, and pressure. See who thrives. The best will become obvious within weeks. But both Ron Conway and Y Combinator are still focused on Silicon Valley. They're still looking for technical founders building software. They're still implicitly filtering for pedigree and network proximity. Dave McClure's insight is that if you truly believe the cost of starting a company has collapsed and the internet has globalized everything, then the opportunity is global. There are talented entrepreneurs in Brazil, India, Southeast Asia, Eastern Europe who will never get funded by Silicon Valley VCs. Not because they're not talented, but because they're outside the network. What if you built a fund that was explicitly global? What if you invested in founders in 50 countries? What if you didn't care about pedigree or Stanford degrees? What if you focused purely on metrics, traction, and hustle? This is the gap 500 startups was created to fill. The world that made it possible was a world where starting a company was cheap, distribution was global, and the traditional gatekeepers were asleep. Dave McClure didn't come from the venture capital establishment. He didn't go to Harvard Business School. He didn't apprentice at Sequoia. His path to venture capital was unconventional, and that shaped everything about how he thought. Born in 1966 in West Virginia, McClure grew up middle class. His father was an engineer. His mother was a teacher. He was good at math and computers but not exceptional. He went to Johns Hopkins for engineering, graduated in 1988, and went to work at a series of tech companies through the 1990s. He wasn't a founder. He wasn't a superstar engineer. He was a product manager and marketer at companies like Netscape and PayPal. Solid companies, important roles, but not the founder track that typically leads to venture capital. What McClure learned during these years was the mechanics of how internet businesses actually work. At Netscape in the mid-1990s, he saw the browser wars and how distribution could create winner-take-all markets. At PayPal in the early 2000s, he learned about viral growth, metrics, and fraud prevention. He learned how to acquire customers cheaply and how to optimize conversion funnels. Most importantly, he learned to think in terms of systems and metrics rather than products and vision. While founders talked about changing the world, McClure focused on customer acquisition cost, lifetime value, conversion rates, and viral coefficients. He understood that great products fail without distribution and mediocre products succeed with great distribution. After PayPal was acquired by eBay in 2002, McClure started angel investing. He had some money from the acquisition and a good network. He wrote small checks to friends and former colleagues who were starting companies. $10,000 here, $25,000 there. No system, just helping people he knew. He was terrible at it. Most of his investments failed. He didn't have a framework. He was investing based on liking the founder or thinking the idea was cool. The success rate was maybe 1 in 20. For every winner like SlideShare, there were 19 companies that went nowhere. But McClure learned something valuable from those early failures. At the seed stage, you can't predict winners. The best ideas often pivot. The best founders aren't always obvious. What matters is iteration speed, customer traction, and capital efficiency. The companies that succeeded were the ones that got to product market fit fastest with the least capital. Around 2007, McClure started writing about startup metrics on his blog. He created a framework called Pirate Metrics, a silly name for a serious idea. Acquisition, Activation, retention, revenue, referral. R. Pirates. Get it? The framework was simple but powerful. Instead of focusing on vanity metrics like page views or downloads, focus on the metrics that actually predict business success. How do you acquire customers? How many actually use the product? How many come back? How much do they pay? How many refer others? This seems obvious now, but in 2007 it was relatively novel. Most founders talked about vision and product. McClure was the guy saying, "Show me your metrics. If you can't measure it, you can't improve it. If you don't know your customer acquisition cost, you're flying blind." The Pirate Metrics framework made McClure famous in startup circles. He started getting invited to speak at conferences. Founders started asking him for advice. He became known as the metrics guy, the person who understood growth hacking before growth hacking was a term. In 2008, McClure joined a small VC firm called Founders Fund as a partner. Founded by Peter Thiel and others from the PayPal mafia, Founders Fund was trying to be contrarian. They backed companies that traditional VCs passed on. They wrote bigger checks than other seed investors but smaller checks than traditional VCs. They were in the messy middle. McClure spent 2 years at Founders Fund and learned what he didn't want to do. The firm was writing $1 to $5 million checks in 20 to 30 companies per year. Still too traditional. Still too slow. Still too focused on pedigree. McClure wanted to go earlier, smaller, faster, and broader. By 2009, McClure had a clear vision. He wanted to create a seed fund that invested in 100 companies per year. $25,000 to $50,000 per company. $2.5 to $5 million deployed per year. Focus on metrics and traction over pedigree. Build a program that taught founders growth hacking and customer acquisition. Go global instead of just Silicon Valley. Everyone thought it was crazy. 100 companies per year? How do you even manage that? You'll never see any of your companies. You won't have time to add value. You're just randomly spraying money. The hit rate will be terrible. McClure's counterargument was simple. At the seed stage, everybody's hit rate is terrible. Even the best seed investors only have maybe 20 to 30% of companies that return capital. Maybe 5 to 10% that return the fund. The power law is extreme. 1 or 2 companies in a portfolio of 50 will generate 90% of returns. Given that reality, the winning strategy isn't better selection. It's more at bats. If your hit rate is 10% and you invest in 20 companies, you'll get 2 winners. If you invest in 100 companies, you'll get 10 winners. More winners means higher expected value even if each individual bet is lower quality. This is the opposite of how traditional VCs think. They believe in selection. Spend 6 months on due diligence. Really get to know the founder. Understand the market deeply. Make fewer, better bets. McClure believed selection is mostly an illusion at the seed stage. Nobody really knows which 2-person team with a prototype will become a billion-dollar company. Better to accept uncertainty and optimize for volume. The other part of McClure's vision was globalization. Silicon Valley VCs were missing most of the world's talent because they only invested in their backyard. McClure wanted to invest in Southeast Asia, Latin America, Eastern Europe, the Middle East. Anywhere there were smart people building things. This wasn't charity. It was alpha. If you could find talented founders in markets where capital was scarce, you could get better deals and ownership. A $25,000 check might buy you 5 or 10% of a company in Vietnam. The same check would buy you 1% in San Francisco. Plus, McClure believed that some of the biggest companies of the next decade would be built outside Silicon Valley. Mobile adoption was faster in developing markets. Internet penetration was growing faster. The next billion internet users would come from Asia, Africa, and Latin America. Why not invest where the growth was? In late 2009, McClure started raising money for 500 startups. The pitch was simple. 100 companies per year. 25 to 50,000 per company. $5 million fund to start. Focus on metrics, distribution, and growth. Global reach. 2 accelerator batches per year with hands-on training. Raising the first fund was hard. Limited partners were skeptical. The traditional LP base for venture capital is institutions, pensions, endowments, funds of funds. They want proven track records. They want experienced investors. They want traditional strategies. McClure had none of that. Instead, McClure raised from individuals. Tech executives who made money from IPOs and acquisitions. Successful entrepreneurs. People who liked the contrarian nature of the strategy and didn't need traditional venture returns to move the needle on their portfolio. He closed the first fund in early 2010 at $3 million. Not $5 million like he wanted, but enough to start. He committed to investing in at least 75 companies in the first year. 25 to 50,000 per company. He rented a small office in Mountain View. He hired 2 people. 1 to help with operations and logistics. 1 to help with deal flow and evaluation. That was the entire team. 3 people to manage 75 investments in year 1. The terms he offered companies were standard for seed stage. He took 5 to 10% equity depending on the valuation. He didn't take board seats. He didn't require control. He just wanted a small piece and the right to invest more in follow-on rounds. In exchange for the investment, companies got access to 500 Startups Accelerator program. For months of training and mentorship. Office space in Mountain View if you could relocate. Introductions to customers, partners, and follow-on investors. Demo day at the end where companies pitched to traditional VCs. The Accelerator program was loosely based on Y Combinator's model but with key differences. YC was focused on helping technical founders become better business people. 500 startups assumed you already had technical skills and focused purely on distribution. Customer acquisition. Growth hacking. Metrics. Conversion optimization. The stuff McClure knew cold. The first batch launched in May 2010 with 20 companies. The companies came from everywhere. Half were international. Several had non-technical founders. Several were in industries VCs typically avoided like e-commerce and consumer services. The only common thread was they all had some early traction. Some evidence that customers wanted what they were building. The program was intense. Weekly workshops on customer acquisition, metrics, viral growth, conversion optimization. One-on-one mentorship with McClure and his team. Constant pressure to show progress. What did you learn this week? What did you ship? What are your numbers? How much did you grow? Demo day in August 2010 was a revelation. 500 startups invited every VC in Silicon Valley. 100 showed up. 20 companies pitched. Most got follow-on funding. Some got term sheets that day. The traditional VCs were impressed but confused. These companies weren't as polished as YC companies. They weren't building deep technology. But they had traction. They had metrics. They knew their customer acquisition cost and lifetime value. They could articulate a path to profitability. McClure raised a second fund in late 2010. $10 million. Limited partners who passed on Fund 1 came back. They saw the demo day. They saw the follow-on funding. They saw that the model might actually work. With $10 million, McClure scaled up. 100 companies in 2011. 2 batches of 50 each. He hired more people. He opened offices in other cities. He started hosting conferences and events to generate deal flow. He became a machine. The early companies validated the thesis. Several got acquired within 2 years for $5 to $20 million. Nothing huge, but solid singles and doubles. A few raised big Series A rounds from top VCs, Twilio, Credit Karma, Wildfire, MakerBot. These weren't 500 startups discoveries, but they were in the portfolio and they demonstrated that the spray and pray approach could surface winners. But the real validation was the ecosystem that started forming. Alumni companies helped each other. Founders from Batch 1 mentored founders from Batch 2. Investors who met McClure through one company came back to invest in others. The network effect started compounding. By 2012, 500 startups had invested in over 300 companies across 30 countries. The portfolio was a mess. Tons of failures. But also dozens of companies that raised Series A. Several that were growing fast. And a few that looked like they might become big. McClure's insight wasn't that he was a better picker than other VCs. His insight was that if you could build a system that processed deal flow efficiently and taught founders the basics of growth, you could generate venture returns with volume instead of selection. The system was the innovation, not the individual bets. The secret of 500 startups wasn't what most people thought. It wasn't Dave McClure's ability to pick winners. It wasn't the quality of the mentorship. It wasn't the global network or the Accelerator program. Those things mattered, but they weren't the core advantage. The real secret was that McClure had built a systematic framework for evaluating and improving startups at the earliest, riskiest stage. A framework that could be taught, repeated, and scaled. A framework based on metrics and evidence rather than intuition and pedigree. Most venture capitalists, even seed-stage investors, make decisions based on pattern matching. They look for founders who remind them of successful founders they've met before. Stanford educated. Previously at Google or Facebook. Technical co-founder who can code. Articulate. Confident. Passionate. This works okay if you're investing in Silicon Valley and most successful founders fit that pattern. But it breaks down when you go global. The best founder in Vietnam might not look anything like Mark Zuckerberg. She might not speak perfect English. She might not have a technical degree. But she might be brilliant at understanding her local market and acquiring customers cheaply. McClure's framework ignored pedigree almost entirely. He didn't care where you went to school or where you worked. He didn't care if you could code. He cared about three things. 1. Did you have a product that at least some customers wanted? 2. Could you acquire customers at a cost that was lower than their lifetime value? 3. Were you learning and iterating quickly? Those three questions sound simple, but they're profound. They cut through all the noise and get to the essence of what makes a startup work. If you have those three things, everything else can be figured out. If you don't, nothing else matters. The first filter was product. Do you have something people want? Not do you have a good idea or a big vision. Do actual customers use your product and would they be upset if it disappeared? If yes, continue. If no, decline. This eliminated 90% of applicants immediately. Most startups at the seed stage don't have product market fit yet. They have an idea and maybe a prototype. McClure wasn't interested in ideas. He wanted evidence. Show me your usage data. Show me your retention curves. Show me that customers actually care. The second filter was unit economics. Can you acquire customers profitably? This sounds basic, but most early-stage founders don't know their numbers. They know they got 10,000 users, but they don't know how much it cost to acquire them or how much those users are worth. McClure's framework forced founders to think about this from day one. What's your customer acquisition cost? What's your lifetime value? What's the ratio? If LTV to CAC is 3:1 or better, you have a business. If it's 1:1 or worse, you have a hobby. This filter was controversial. Many VCs argue that you shouldn't worry about unit economics at the early stage. Just focus on growth. Worry about monetization later. McClure thought this was insane. If you can't make money on each customer, scaling just means losing money faster. There were exceptions. Marketplaces and network effects businesses might have bad unit economics early but get better with scale. consumer social products might monetize through ads later. McClure would invest in these, but only if the founder had a credible plan for how unit economics would improve. The third filter was iteration speed. How fast are you learning and adapting? This was the hardest to measure but maybe the most important. The companies that succeed at the seed stage aren't the ones with the best initial idea. They're the ones that learn fastest from customers and iterate quickly. McClure would ask founders, "What did you learn last week? What experiment did you run? What surprised you?" The best founders had detailed answers. They talked about A/B tests they ran, customer interviews they did, features they shipped. They were in motion. The worst founders talked in abstractions. "We're building the Uber for X. We're going to be huge." When pressed on details, they didn't have any. They hadn't talked to customers. They hadn't shipped anything. They were in planning mode. Planning mode is death for a startup. The only way to learn is by shipping and getting feedback. McClure was ruthless about this. If you haven't shipped something in the last 2 weeks, you're not moving fast enough. These three filters, product traction, unit economics, and iteration speed, were the core of 500 Startups evaluation framework. They could be applied in any market, any industry, any geography. You didn't need to understand the local context deeply. You just needed to see the data. This is why McClure could invest in Brazil, India, Southeast Asia without living there. He wasn't evaluating based on his gut sense of whether the founder was credible or whether the market opportunity was real. He was evaluating based on metrics that were universal. But evaluation was only half the system. The other half was improvement. Most seed investors write a check and hope for the best. They're available for advice if founders ask, but they don't have a systematic way of helping companies. McClure built a curriculum. For months of intensive training on the specific skills that matter most at the seed stage. Not product development. Not technology. Not fundraising. Just distribution. Customer acquisition. Growth hacking. The curriculum had 10 core modules. 1. Defining your customer. Who exactly are you targeting and why? 2. Customer acquisition channels. What are all the ways you could reach customers and which are worth testing? 3. Conversion optimization. How do you turn visitors into users into paying customers? 4. Retention and engagement. How do you keep customers coming back? 5. Viral mechanics. How do you get customers to refer others? 6. Monetization. How do you charge and what's the optimal pricing? 7. Metrics and analytics. What should you measure and how? 8. Experiments and testing. How do you run rigorous A/B tests? 9. Cohort analysis. How do you track customer behavior over time? 10. Scaling what works. How do you amplify the channels that work? Each module included lectures, workshops, case studies, and homework. Founders were expected to run experiments every week and report results. McClure and his team reviewed the data and provided feedback. What worked? What didn't? What should you try next? The pressure was intense. Some founders thrived. They loved the structure and the focus on metrics. They ran dozens of experiments and learned fast. These were the companies that usually succeeded. Other founders hated it. They felt like McClure was reducing startups to spreadsheets. They wanted to focus on product and vision, not conversion funnels and A/B tests. These companies usually failed or left the program early. McClure didn't care if founders liked him. He cared if they succeeded. His theory was that at the seed stage, vision doesn't matter much. Execution matters. Distribution matters. Learning fast matters. You can have a great product and fail if nobody knows about it. You can have a mediocre product and succeed if you're great at customer acquisition. This was heresy in Silicon Valley. The dominant ideology was build something people want and they'll find you. Make the product great and growth will follow. McClure thought this was naive. Distribution is never automatic. You have to build it just like you build the product. The curriculum worked. Companies that went through 500 Startups program were measurably better at customer acquisition than comparable companies. They knew their metrics. They ran experiments. They found product market fit faster. But the real power of the system was the network effects. After the first few batches, McClure had hundreds of alumni. These founders became mentors, advisors, and investors for the next batch. They shared what worked. They made introductions. They helped with hiring and partnerships. This created a flywheel. The more companies McClure invested in, the stronger the network became. The stronger the network, the more value he could provide. The more value he provided, the more companies wanted to join. The more companies joined, the more data he had about what worked. The more data he had, the better his framework became. By 2013, 500 startups had a massive informational advantage. McClure had data on over 500 companies across every geography, every industry, every customer segment. He could see patterns that nobody else could see. For example, he discovered that in Southeast Asia, Facebook ads were much cheaper than in the US, but conversion rates were similar. This meant companies could acquire customers for 1/10 the cost. Armed with this insight, he pushed his Southeast Asian portfolio companies to scale customer acquisition aggressively. Several became market leaders in their categories. He discovered that marketplace businesses in Latin America had better unit economics than in the US because competition was lower and customers were more loyal. This led him to invest more heavily in Latin American marketplaces. He discovered that mobile-first companies in emerging markets grew faster than web-first companies because smartphone penetration was higher than PC penetration. This shifted his focus toward mobile. These insights seem obvious in retrospect, but in 2012 and 2013, they weren't common knowledge. McClure had the data because he had the portfolio. He could see what worked and what didn't across hundreds of experiments. This was his sustainable competitive advantage. The other advantage was speed. Traditional VCs take 3 to 6 months to make an investment decision. Due diligence, partner meetings, reference checks, negotiation. By the time they move, the opportunity might be gone. McClure could make a decision in one meeting. 15 minutes. Show me your traction data. Show me your unit economics. Show me evidence you're iterating fast. Yes or no? If yes, term sheet in 24 hours. Money wired in a week. This speed was possible because of the framework. McClure wasn't trying to predict the future or deeply understand the market. He was looking for evidence of present traction and rapid learning. Those things could be assessed quickly. Speed mattered because at the seed stage, momentum is everything. Startups die from running out of money or losing momentum. A fast yes from McClure could be the difference between a company surviving or dying. Founders appreciated that. But speed also had costs. McClure made mistakes. He invested in companies that looked good on metrics but had fundamental flaws. Fake traction. Unsustainable unit economics. Founders who were good at growth hacking but bad at everything else. The hit rate was lower than traditional VCs. Maybe 15 to 20% of companies returned capital. Maybe 5% returned the fund. But because he invested in so many companies, the absolute number of winners was high. 20 winners out of 400 investments is a lot of winners. The system worked. 500 startups generated strong returns in its early funds. Fund 1 returned over 3x, Fund 2 returned over 2x. These weren't spectacular returns compared to the best VC funds, but they were solid and they proved the model. More importantly, McClure had built something that could scale. The framework could be taught. The curriculum could be replicated. The network effects compounded over time. He could invest in 1,000 companies just as easily as 100. Or so he thought. The period from 2010 to 2014 was 500 startups' golden age. Everything was working. The portfolio was growing. Returns were solid. The brand was strong. McClure was becoming famous. But beneath the surface, cracks were forming. The first challenge was the sheer volume. By 2013, 500 startups had invested in over 400 companies. McClure had maybe 10 people on his team. That's 40 companies per person. How do you possibly provide meaningful support to 40 portfolio companies? The answer is you don't. Despite the promises of hands-on help and mentorship, most portfolio companies barely heard from 500 startups after the check cleared. There just wasn't time. McClure was traveling constantly, running new accelerator batches, raising new funds, speaking at conferences. His team was overwhelmed. This created a problem. If you're a founder and you take money from 500 startups expecting help with customer acquisition and growth, and then you get radio silence, you're going to be disappointed. Some founders felt used. They gave up equity for a small check and got nothing in return except the brand association. McClure's response was that founders should be more self-sufficient. The Accelerator program gave you the framework. The network gave you connections. You shouldn't need hand-holding. If you do, you're probably not going to succeed anyway. This was technically true but also a cop-out. 500 startups marketed itself as hands-on. The pitch was, we're not just capital, we're growth experts who will help you scale. When that help didn't materialize for most companies, it damaged trust. The second challenge was adverse selection. As 500 startups became well known, the quality of applicants changed. In the early days, McClure found hidden gems. Founders who couldn't get funding from traditional VCs but who were talented and resourceful. By 2013, 500 startups was getting flooded with applications from founders who had been rejected everywhere else. This is a common problem with high-volume models. When you're new and scrappy, you get interesting deal flow because you're an alternative to the establishment. When you become established yourself, you get the leftovers. McClure tried to maintain quality through the metrics-based framework, but metrics can be gamed. Founders learned what McClure wanted to see. They knew he wanted traction, so they bought users. They knew he wanted good unit economics, so they cherry-picked the data. They knew he wanted iteration speed, so they shipped lots of small features that didn't matter. The framework that worked so well when applied honestly stopped working when founders figured out how to game it. McClure and his team didn't have time to dig deep enough to spot the fakes. They were processing too many deals too fast. The hit rate started declining. Fund 3 and Fund 4, raised in 2013 and 2014, would eventually post mediocre returns. Not disasters, but not the strong performance of the first two funds. The system was breaking down. The third challenge was global expansion. McClure's vision was to invest in great founders everywhere. By 2013, 500 startups had backed companies in over 50 countries. This sounded impressive, but it created massive operational complexity. Different countries have different legal systems, different tax rules, different cultural norms. Wiring $25,000 to a company in Vietnam requires different paperwork than wiring it to a company in California. Following up on investments, tracking progress, providing support, all of this is much harder across time zones and languages. McClure's team didn't have the infrastructure to handle this complexity. They were still operating like a small seed fund in Silicon Valley. They had one lawyer, one CFO, one operations person. These people were drowning in paperwork. More fundamentally, the global portfolio made it impossible to add value. McClure couldn't be the growth expert for a company in Brazil if he didn't understand the Brazilian market, the Portuguese language, or the local customer acquisition channels. The framework could identify promising companies anywhere, but it couldn't help them succeed without local expertise. 500 startups tried to solve this by hiring regional partners. People based in Southeast Asia, Latin America, Eastern Europe who could source deals and support companies locally. This helped, but it created a new problem. How do you maintain culture and quality control when your team is distributed across the world? The regional partners were hired fast. Some were great. Some were mediocre. Some made bad investments because they didn't really understand the framework. Some made good investments but couldn't provide support because they lacked McClure's expertise. Quality became wildly inconsistent. The fourth challenge was fund size. McClure kept raising bigger funds. Fund 1 was 3 million. Fund 2 was 10 million. Fund 3 was 50 million. Fund 4 was 100 million. Bigger funds meant more capital to deploy, which meant more investments, which meant less time per investment. This sounds like a good problem, but it's actually a disaster for seed funds. The whole model depends on having enough time to evaluate opportunities and support winners. When you're deploying $100 million in $25,000 checks, you need to make 4,000 investments. That's impossible to do with quality. McClure tried to solve this by writing bigger checks. Instead of 25,000, write 100,000 or 250,000. But this changed the strategy. At 250,000, you can't spray and pray as much. You need higher conviction. You need more diligence. You're back to being a traditional seed fund. The model that worked at 3 million didn't scale to 100 million. McClure didn't realize this until it was too late. He was too focused on growth, on building a global brand, on making 500 startups the biggest seed fund in the world. He lost sight of what made the model work in the first place. The fifth challenge was mission drift. 500 startups started with a clear focus. Early-stage consumer internet companies focused on growth and distribution. Simple. By 2014, the portfolio included enterprise software, hardware, biotech, marketplaces, consumer services, developer tools. Everything. This made sense from a diversification perspective. Don't put all your eggs in one basket. But it meant McClure and his team couldn't be experts in anything. The growth hacking curriculum that worked great for consumer internet companies was useless for enterprise software sales or hardware manufacturing. 500 startups tried to build separate programs for different verticals, but this diluted the brand and confused the value proposition. Were they growth experts or were they generalists? Were they focused or were they opportunistic? The answer became unclear. Despite these challenges, 500 startups kept growing. By 2015, they had invested in over 1,000 companies. McClure raised Fund 5 at $150 million. The brand was at its peak. They were hosting huge conferences, running demo days with 500 attendees, getting media coverage constantly. From the outside, it looked like overwhelming success. From the inside, things were messy. The organization was stretched thin. The team was burning out. The returns were declining. And nobody wanted to admit it because McClure's ego was too big and the momentum was too strong. Then came 2008. The year that nearly destroyed 500 startups. In July 2017, the New York Times published an investigation into sexual harassment in the tech industry. The story focused on several prominent venture capitalists, and Dave McClure was named prominently. Multiple women came forward with allegations that McClure had behaved inappropriately. Making advances toward female founders. Propositioning women at conferences. Using his position as an investor to pressure women into uncomfortable situations. The details were damning. McClure initially tried to deflect, then issued a public apology. He called his behavior unacceptable and said he was ashamed. He announced he would step back from day-to-day operations at 500 startups. Within weeks, he resigned as general partner. The scandal was devastating. 500 startups brand, built over 7 years, was destroyed overnight. Limited partners were furious. Portfolio companies distanced themselves. The tech press, which had celebrated McClure as a democratizing force in venture capital, now portrayed him as an example of everything wrong with Silicon Valley's culture. many people who worked at 500 startups or took money from the fund felt betrayed. They had believed in McClure's mission of democratizing access to capital. They had defended him when critics said he was just spraying money randomly. Now they learned he had been abusing his power in the most personal ways. The scandal revealed something that should have been obvious earlier. 500 startups culture was toxic. The aggressive, move fast and break things mentality that McClure promoted in startups had infected the organization itself. There was no HR. No accountability. No systems to prevent abuse. McClure was the benevolent dictator, and dictators are never actually benevolent. The irony is brutal. 500 startups were supposed to be different from Sand Hill Road. More inclusive. More global. More meritocratic. Instead, it replicated the same power dynamics and problematic behavior, just at higher volume. After McClure resigned, the remaining partners tried to salvage the firm. Christine Tsai, who had been Chief Operating Officer, became CEO. She immediately implemented new policies. Mandatory sexual harassment training. HR systems. Ethics guidelines. An independent review of past behavior. But the damage was done. Fund 5, which was supposed to raise $200 million, struggled to close. Several limited partners pulled out. The final size was $140 million, and it took a year longer than planned to raise. More importantly, deal flow dried up. Founders didn't want to be associated with 500 startups. Other VCs started bad-mouthing the firm. The network effects that had been 500 startups' biggest advantage went into reverse. Instead of alumni helping each other, people pretended they had never been involved. The scandal also exposed deeper problems with the model. When your advantage is volume and network effects, reputation is everything. If founders don't want your money, the model breaks. You're just another small check. 500 startups survived, but it never recovered its momentum. The firm continued operating under new leadership, but it was a shadow of what it had been. The bold vision of investing in 500 companies per year globally with a systematic framework for growth was abandoned. The firm became just another seed fund, smaller and more conservative. Looking back, the scandal was both a cause and a symptom. The cause of 500 startups' downfall in terms of immediate impact on reputation and fundraising. But also a symptom of deeper organizational dysfunction. The lack of systems. The cult of personality around McClure. The prioritization of growth over sustainability. The tolerance of bad behavior in pursuit of returns. The real tragedy is that 500 startups' original insight was correct. The venture capital industry did need to be democratized. There were talented entrepreneurs outside Silicon Valley who deserved access to capital. A systematic, metrics-based approach to seed investing could work at scale. These ideas were valuable and important. But good ideas require good execution, and good execution requires healthy organizations with strong cultures and ethical leadership. 500 startups had none of these things. It was built on McClure's charisma and the momentum of a booming market. When those ran out, there was nothing left. The period from 2017 to 2020 was a slow-motion collapse. 500 startups limped along, making investments, supporting portfolio companies, trying to raise new funds. But the magic was gone. The firm made some good investments during this period. Canva, the design software company, became a massive success. TalkDesk, the customer service platform, reached unicorn status. Credit Karma, which 500 startups had backed early, sold to Intuit for over $7 billion. But these wins were from the early funds, investments made in 2011 to 2014 when the model was still working. The later funds, particularly funds 4, 5, and 6, were struggling. Too many companies failed. Too few returned capital. The system that worked at small scale didn't work at large scale. Christine Tsai tried to rebuild. She focused on quality over quantity. She reduced the number of investments per year from 100 plus to maybe 30. She hired more experienced investors. She built better systems for portfolio support. She tried to restore the firm's reputation. These were all correct moves, but they also meant 500 startups was no longer distinctive. Writing 30 seed checks per year with hands-on support is what every seed fund does. The volume model, the spray and pray approach, the global ambition, all of that was abandoned. In 2020, 500 startups announced it was splitting into separate funds by geography. 500 startups US. 500 startups Southeast Asia. 500 startups Latin America. Each fund would operate independently with its own team and strategy. This made operational sense but killed the network effects. The power of 500 startups had been the global portfolio. A company in Vietnam could get introductions to customers in Silicon Valley. A company in Brazil could learn from experiments run by a company in India. Breaking up the portfolio meant breaking up the network. By 2021, the firm that invested in over 1,500 companies was barely recognizable. McClure was gone. Most of the original team was gone. The brand was damaged. The returns were mediocre. The vision was compromised. What went wrong? At one level, the answer is obvious. Sexual harassment scandal. Founder hubris. Growing too fast. But at a deeper level, 500 startups failed because it never solved the fundamental tension in its model. The tension is this. Seed investing benefits from network effects and data accumulation, which suggests you want high volume. But seed investing also requires deep engagement with founders and understanding of markets, which suggests you want focus and quality. 500 startups tried to do both and ended up doing neither well. At 50 companies per year, maybe you can maintain quality and build network effects. At 100 companies per year, you're pushing the limits. At 200 or 300 companies per year, which is what 500 startups was doing at its peak, something has to give. Either quality declines or you don't actually provide meaningful support. McClure believed you could solve this with systems and curriculum. Teach founders the framework, give them the network, then get out of the way. But most founders at the seed stage need more than a framework. They need judgment, pattern recognition, emotional support, strategic guidance, things that require time and relationship. Y Combinator solved this problem by staying small and selective. They do 2 batches per year, maybe 200 companies total, with a large team of partners who provide intensive support. They can scale revenue through repeat founders and their brand, but they don't scale the core model. 500 startups try to scale the core model by lowering the bar for support. We'll give you the tools and network, but you have to execute yourself. This works for exceptional founders who just need capital and connections. It doesn't work for the median founder who needs mentorship. The other problem was that McClure's framework, while innovative in 2010, became common knowledge by 2015. Pirate metrics, growth hacking, metrics-driven decision-making, all of this became standard practice. Every accelerator taught it. Every startup book covered it. Every founder internalized it. When your advantage is a framework and everyone learns the framework, you need a new advantage. McClure never found it. He just kept scaling the old model, which stopped working as competition increased and the framework diffused. The final problem was that McClure conflated the firm's success with his own genius. He believed he was special, that he saw things others didn't, that the rules didn't apply to him. This manifested in his personal behavior, but it also manifested in his business decisions. He raised funds that were too big. He expanded into markets too fast. He hired people too quickly. He thought he could do no wrong. Hubris destroys more great things than any external force. 500 startups wasn't killed by competition or market conditions or bad luck. It was killed by its founder's ego and the organizational dysfunction that ego created. Today, 500 startups still exists. It still invests in companies. It still runs programs. But it's a minor player in the venture capital ecosystem. The firm is remembered as a cautionary tale rather than a success story. The irony is that McClure's core insight was right. The venture capital industry needed to be disrupted. Too much capital was concentrated in too few hands, making too few investments in too narrow a slice of opportunities. A more systematic, data-driven, global approach to seed investing could generate strong returns while democratizing access. But being right about the problem doesn't mean you'll solve it. 500 startups proved that disruption is hard, that scaling is hard, that building a healthy organization is hard. It showed that you can have a great idea and still fail if you can't execute with discipline and integrity. The story of 500 startups is not the story McClure wanted to tell. He wanted to be remembered as the guy who democratized Silicon Valley, who gave thousands of entrepreneurs a chance, who built a global platform for innovation. Instead, he'll be remembered for the scandal that ended his career and the firm that could have been great but wasn't. But there's still value in the story. Not as a success to emulate but as a failure to learn from. What can we learn from 500 startups' rise and fall? The first lesson is about the importance of sustainable competitive advantage. 500 startups' advantage in the early years was a combination of framework, network effects, and global reach. But frameworks can be copied. Network effects only work if you maintain quality. Global reach creates complexity. The sustainable advantage in venture capital is judgment accumulated over decades and relationships built through trust. These things can't be scaled through systems or curricula. They require time, focus, and integrity. McClure tried to shortcut this by replacing judgment with metrics and relationships with volume. It worked for a while but couldn't last. The second lesson is about scaling. In venture capital, bigger isn't always better. A $3 million fund that returns 5x is more valuable to investors and more impactful to the ecosystem than a $300 million fund that returns 1.5x. But the incentives push toward bigger funds because management fees scale with size. McClure got trapped by this incentive structure. As 500 startups raised larger funds, his personal economics improved, but the firm's strategy deteriorated. He was making more money but generating worse returns. The limited partners who invested in later funds got screwed. This is a common problem in asset management. When you find something that works, the temptation is to scale it as much as possible. But many strategies have diseconomies of scale. They work at small size and break at large size. The skill is knowing where the inflection point is and having the discipline to stop before you reach it. The third lesson is about culture and values. McClure thought culture was irrelevant or that culture would automatically emerge from the work. He was wrong. Culture is everything, especially in an organization that depends on trust and collaboration. The toxic culture at 500 startups wasn't an accident. It was the inevitable result of having no systems, no accountability, and a leader who believed he was above the rules. This culture manifested in the sexual harassment scandal, but it also manifested in sloppy investing, poor portfolio support, and eventual organizational failure. Building a healthy organization requires intentionality. You have to define values explicitly. You have to hire and fire based on those values. You have to create systems that reinforce them. You have to hold people, especially leaders, accountable when they violate them. McClure did none of this. The fourth lesson is about the limits of disruption. 500 startups positioned itself as the disruptor taking on the venture capital establishment. This was good marketing and there was truth to it. But disruption for its own sake isn't valuable. Disruption is only valuable if the new model is actually better than the old model. In 500 startups' case, the new model had advantages at the margin but also serious disadvantages. Higher volume meant lower quality. Global reach meant less depth. Metric focus meant missing intangibles. The new model wasn't obviously better, just different. Real disruption requires building something that's 10x better, not 10% different. Y Combinator disrupted venture capital by being 10x better at finding and supporting early-stage companies. 500 startups tried to disrupt by being different, but different isn't enough. The fifth lesson is about the role of the founder. McClure was 500 startups. The firm's strengths were his strengths. The firm's weaknesses were his weaknesses. When he fell, the firm fell. This is dangerous. Building a firm around a single personality creates fragility. If that person leaves, dies, or gets cancelled, the firm collapses. The alternative is to build institutions that can outlive their founders. This requires systems, succession planning, distributed leadership, strong culture. McClure never built 500 startups to outlive him. He built it as an extension of himself. This is common among entrepreneur investors, but it limits longevity and impact. The sixth lesson is about ethics and power. Venture capital gives investors enormous power over founders. You control capital that entrepreneurs desperately need. You have relationships they want access to. You can make or break careers with a yes or no. This power must be handled with extreme care and integrity. When McClure used his power to pressure women into uncomfortable situations, he betrayed the trust that makes venture capital work. Founders need to believe that investors are there to help them, not exploit them. The scandal destroyed 500 startups, but it also damaged the entire seed investing ecosystem. It made founders more skeptical of investors. It made women more reluctant to work with male investors. It reinforced the perception that Silicon Valley is a boys' club where abuse is tolerated. Rebuilding that trust takes decades. McClure destroyed in months what took years to build. The seventh lesson is about the importance of honest performance measurement. Throughout 500 startups' history, the firm emphasized its portfolio size and brand over actual returns. We invested in 1,500 companies in 50 countries. We had 10 exits last quarter. We're the most active seed investor in the world. But portfolio size and exit count don't matter if the returns are mediocre. A single great investment can return a fund. 10 mediocre exits might not. The only metric that matters in venture capital is IRR and TVPI to limited partners. 500 startups was never transparent about performance. They highlighted wins and buried losses. They talked about gross returns, not net returns. They focused on markups, not realizations. This lack of transparency let them raise larger funds than performance justified. Limited partners who invested in later funds likely lost money or made less than they would have in an index fund. This is unacceptable. If you're a fiduciary managing other people's money, you have an obligation to be honest about performance and to stop raising money when the strategy stops working. McClure kept raising larger funds because he could, not because he should. This is a failure of integrity and fiduciary duty. The eighth lesson is about the difficulty of global investing. McClure's vision of backing great entrepreneurs anywhere was inspiring. But executing global investing requires local expertise, relationships, and cultural understanding. 500 startups tried to solve this with regional partners, but they never built the infrastructure to support them properly. The regional partners were spread thin, under-resourced, and inconsistently trained. The result was a portfolio that was globally diverse but shallow. Successful global investors like Sequoia or SoftBank either build strong local teams with autonomy or focus on a few markets where they can develop deep expertise. 500 startups tried to be everywhere at once and ended up with meaningful presence nowhere. Going global sounds great, but it requires massive investment in infrastructure, people, and relationships. If you're not willing to make that investment, it's better to stay focused. The ninth lesson is about the value of saying no. McClure's model was based on saying yes a lot. 100 investments per year means you're saying yes to everything that meets minimum thresholds. This is antithetical to how great investors operate. Great investors say no 99 times and yes once. They wait for the perfect opportunity, the perfect founder, the perfect moment. They have conviction and concentration. They make fewer bets with higher confidence. McClure's spray and pray approach was based on the belief that selection is impossible at the seed stage, so you might as well maximize volume. But this belief is only partially true. Selection is difficult, but not impossible. The best seed investors have hit rates of 30 to 40%, not 10 to 15%. The difference is discipline. Saying no to good opportunities because they're not great. Saying no to founders you like because they're not exceptional. Saying no to markets you understand because the timing isn't right. This discipline is painful but essential. McClure didn't have this discipline. His default was yes unless something was obviously wrong. This led to a bloated portfolio full of mediocre companies. The 10th and final lesson is about redemption and second chances. After the scandal, McClure essentially disappeared from the tech industry. He issued an apology, stepped back from 500 startups, and went quiet. He didn't try to make a comeback or rehabilitate his image. Some people think this is appropriate. He abused his power and should face consequences. Others think the punishment was disproportionate. He made serious mistakes but also did meaningful good through 500 startups. The question of redemption is complicated. Should someone who behaved badly but contributed positively get a second chance? If so, what should they have to do to earn it? There's no clear answer. But what's clear is that McClure's story is a reminder that reputation is fragile and trust is easily lost. You can spend a decade building something valuable and destroy it in a day. This should make all of us more careful about how we treat people and use power. Today, the venture capital industry looks different than it did when McClure started 500 startups in 2010. Seed investing has become professionalized. Metrics and growth hacking are standard practice. Accelerators are everywhere. Global investing is common. In some ways, McClure's vision won. The industry is more accessible, more data-driven, more global than it was 15 years ago. But in other ways, the old establishment endures. The best deals still go to the best firms. Pedigree still matters. Silicon Valley still dominates. The company's 500 startups back tell the story of its impact. Credit Karma saved Americans billions in financial fees. Canva democratized design for millions. TalkDesk improved customer service worldwide. MakerBot helped start the maker movement. These are meaningful contributions. But they're contributions that would have happened anyway. These companies would have found funding elsewhere. They didn't need 500 startups. The question is whether 500 startups funded companies that wouldn't have been funded otherwise. The answer is yes, but fewer than McClure hoped. Most of the 500 startups portfolio companies that succeeded were the same companies that could have raised from other investors. The truly marginal companies, the ones in overlooked markets with non-traditional founders, mostly failed. This suggests that access to capital wasn't the binding constraint. The binding constraint was founder quality and market opportunity. Giving capital to mediocre founders in mediocre markets doesn't create success. It just delays failure. The real success stories in democratizing entrepreneurship have come from infrastructure improvements, not capital availability. AWS made starting a company cheaper. Smartphones made distribution global. Online education made learning accessible. These infrastructure changes created millions of entrepreneurs who wouldn't have existed before. Capital follows infrastructure. Once it's cheap to start a company and easy to reach customers, investors appear to fund the best opportunities. McClure thought capital was the constraint and tried to solve it with 500 startups. But capital was never really the constraint. Despite its failures, 500 startups proved that alternative models for seed investing can work. You don't have to copy Sequoia or Benchmark. You can experiment with volume, velocity, geography, focus. Some experiments will fail, but some will succeed. The firms that learned from 500 startups and avoided its mistakes have thrived. Hustle Fund, for example, took the volume model but stayed smaller and more focused. Village Global built a global network but maintained higher quality bars. OnDeck adapted the Accelerator model for experienced founders. These firms understood that the right scale for seed investing is probably somewhere between Sequoia's 1 fund per year with 15 investments and 500 startups' 2 funds per year with 200 investments. maybe 50 to 75 investments per year is optimal. Enough for diversification and network effects, but not so many that you can't provide meaningful support. They also understood that culture and integrity matter. Building a firm requires more than deal flow and returns. It requires values, systems, accountability, respect. McClure's story is ultimately a tragedy. Not a Shakespearean tragedy where a great man is brought down by a fatal flaw, but a modern tragedy where good intentions, innovative thinking, and genuine impact are undermined by ego, carelessness, and ethical failures. He saw something real. The venture capital industry needed disruption. Too much capital was concentrated in too few hands, making too few bets on too narrow a slice of opportunities. A more systematic, data-driven, global approach could work. He built something meaningful. 1,500 companies funded. Dozens of successful exits. Billions in value created. Thousands of entrepreneurs given a chance they wouldn't have had otherwise. But he also caused real harm. Women who were harassed and felt unsafe. Limited partners who invested in later funds and lost money. Employees who believed in the mission and felt betrayed. Founders who took money and got no support. In the end, the harm outweighs the good. Or maybe they're incommensurable. How do you weigh creating jobs and funding innovation against abusing power and violating trust? There's no equation that balances these things. What's clear is that 500 startups could have been something special. If McClure had been more disciplined about scaling. If he had built a healthy culture. If he had maintained ethical standards. If he had focused on sustainable competitive advantage rather than growth at all costs. But he didn't. And so 500 Startups is remembered not as the firm that democratized venture capital, but as a cautionary tale about what happens when ambition exceeds wisdom and power corrupts integrity. The next generation of investors should learn from both 500 Startups' innovations and its failures. The innovations, systematic frameworks for evaluating startups, focus on metrics and distribution, global perspective, willingness to challenge orthodoxy, these are valuable. The failures, growing too fast, neglecting culture, abusing power, lacking discipline, prioritizing brand over performance, these are avoidable. Build slowly. Stay focused. Maintain integrity. Respect people. Measure honestly. These aren't revolutionary insights, but they're essential. 500 Startups forgot them. Don't make the same mistake. The story ends not with a bang but with a whimper. 500 Startups still exists, still invests, still operates programs. But the vision is gone. The ambition is gone. The belief that venture capital can be fundamentally different is gone. Maybe that's okay. Maybe venture capital doesn't need to be fundamentally different. Maybe the old model, refined and improved at the margins, is good enough. Maybe disruption isn't always valuable. Or maybe 500 Startups' failure just means someone else will try next. Someone who learns from McClure's mistakes. Someone who combines his innovative thinking with better execution and stronger ethics. Someone who finally cracks the code on how to democratize access to capital without sacrificing quality or integrity. That's the story still waiting to be written. 500 Startups didn't write it. But maybe someone else will. Until then, we're left with the story of what was, what could have been, and what we can learn from the gap between them. That's the real value of 500 Startups' legacy. Not the companies funded or the returns generated, but the lessons taught about ambition, innovation, scaling, culture, and the responsibility that comes with power. These lessons are worth remembering. They're worth teaching. They're worth internalizing for anyone who wants to build something that lasts. Dave McClure tried to change venture capital. He succeeded in changing it, just not in the way he intended. His real legacy isn't the firm he built, but the conversation he started about how venture capital should work and who it should serve. That conversation continues. The question of how to democratize access to capital while maintaining quality. The tension between volume and focus. The challenge of scaling without losing what makes you special. The importance of culture and integrity in building institutions. These are the questions that matter. 500 startups didn't answer them definitively, but it explored them honestly. That's worth something. In the end, maybe that's enough. Not the triumph McClure wanted, but not nothing either. A complicated story with insights and warnings in equal measure. A reminder that building something meaningful is hard, that innovation requires humility, and that the distance between success and failure is often smaller than we think. This has been the story of 500 startups. The batch factory that tried to democratize Silicon Valley. The firm that proved alternative models can work, but that execution matters more than innovation. The cautionary tale about what happens when growth outpaces wisdom. Remember the innovations. Learn from the failures. Build something better. That's the challenge for the next generation. Can you take McClure's best ideas and execute them with more discipline and integrity? Can you democratize venture capital without compromising quality? Can you scale without losing your soul? The answer isn't certain. But it's worth trying. Because the underlying problem is real. Too much capital in too few hands serving too narrow a slice of entrepreneurs. If someone can solve that problem while avoiding 500 startups' mistakes, they'll build something truly important. Until then, we have this story. Imperfect, complicated, human. A story about ambition and hubris, innovation and failure, impact and harm. The story of 500 startups. A firm that could have changed everything and instead became a warning about what not to do. But also a firm that tried. That took risks. That challenged the establishment. That gave thousands of entrepreneurs a chance. That counts for something. Not everything. But something. And maybe, in the end, that's all any of us can hope for. To try. To risk. To build. To fail with lessons others can learn from. 500 startups did that. The rest is history.